Today, we're going to break down a surprising spike in Canadian mortgage originations, basically a big jump in new mortgages being signed. This topic caught public attention recently because the real estate market is not performing well at all. So in this video, I'm going to explain what this spike really means and why you shouldn't be immediately alarmed by the big number. I'm going to talk about what mortgage originations are. Hint, it's not just new home purchases. I'm going to introduce the idea of this renewal wall, which you've heard a lot about, I'm sure. And I'm going to explain something called the base effect that makes this jump look extra large. And most importantly, discuss why this matters to you, somebody who is interested in the real estate market for whatever reason that might be. Touching on affordability, interest rates, and what policymakers might do about this. So the headline says that Canadian mortgage origination surged 22%, the second biggest June on record. But the first question here is, what exactly do we mean by mortgage origination? In simple terms, an origination is any new mortgage loan that is started. Many people hear originations and think it's only a purchase of a house, buying a new home, getting a brand new mortgage for that. But in the data that we're discussing and the data used in this headline, originations include more than just first time or new home mortgages. They also include refinances and renewals, because when a mortgage comes up for renewal, that mortgage contract is over and then a new mortgage contract is initiated. This is how Canada works with 5-year mortgage terms. And so the recent surge in originations isn't just because tons of people suddenly bought houses. In fact, it's quite the opposite. It's largely because many existing homeowners had to renew or refinance their mortgages. In fact, according to the Bank of Canada, about 60% of all outstanding mortgages in Canada will renew in 2025 or 2026. This is that renewal wall where you have this huge number of mortgages coming up for renewal. And the wall part of it is that all of those people who would be renewing would have gotten their mortgages on average in 2020 or 2021 when interest rates were substantially lower. While you might see this data point and say mortgage originations are way up and think, well, that must mean there's a lot of activity in the housing market, it could actually be quite the opposite. It might mean that there's very little activity in the housing market because so many people are renewing their mortgages. And a lot of those people are renewing their mortgages now at much higher rates. The Bank of Canada did observe that the average payment increase for mortgages renewing in 25-26 would be smaller than it was originally anticipated because rates have come down. But it's still going to be relatively painful for the average homeowner. They're going to see their mortgage payment go up. By late 2024, over half of all new mortgage originations were actually renewals or refinances, not new purchases, according to Equifax. And that trend only grew in 2025. Now, again, you might have heard experts talk about this mortgage renewal wall, and it sounds dramatic, but it's a good metaphor. Imagine a huge wave of mortgages all coming due around the same time. That's the wall. Why is this happening right now? 5 years ago, interest rates were at record lows, and a ton of Canadians took out mortgages or last renewed around that time to try and capture those low rates. Now you fast forward, those typically 5-year terms from 2020 and 2021 are expiring in 25 and 26, creating this flood of renewals. Now, just how big is this wave? More than 4 million mortgages, roughly 60% of all outstanding mortgages, according to the Bank of Canada, will renew in 25 and 26. Think about that. Over half of Canadian mortgages are hitting renewal in just a 2-year span. And because we had record purchases during 20 and 2021 and at record prices, many of these homeowners are facing their first renewal ever, or their first renewal in a rising interest rate environment. During the pandemic, some people had interest rates as low as 1% to 2%. Now they're renewing at much higher rates, which is going to be a huge adjustment. This could have a lot of downward pressure on the market as people who maybe are stretched too thin are experiencing financial stress. We've got a lot of other problems going on in the market, job losses, inflation that people are dealing with, other loans are going delinquent. The logical thing to do if you're backed up against a wall by this credit cycle is sell your home, realize the equity, use it to square up your financial situation. And a lot of people talk about how Canadians don't want to sell their houses. The last thing they'll do is try and sell their house to fix financial problems. But I think that Canadians, a lot of economists have talked about this in relation to the 1990s recession. Canadians have a really strong inflation psychology, it's called. And to the upside, when prices are rising, that means that Canadians are more likely to go and spend to try and front run inflation. If they think that prices are going to run away from them, they'll try and buy the thing now so they don't have to pay a higher price for it later. If they have a high inflation psychology, they would also have a high deflation psychology, which means that they're probably equally hyper aware of prices falling. And this is a big reason why people aren't jumping into the housing market right now. Nobody's in a rush to buy. And this is why economists are so afraid of deflation, not just in the context of houses, but in the context of goods. Imagine you go walk into Walmart and TV's on sale, and you've been in the market for a TV. TV's on sale, you're out buying groceries or whatever, TV's on sale, they're maybe 20% off. And then the next time you go buy groceries, you see them at 30% off or 25% off. Logic would tell you that prices of TVs are probably going down if you're seeing the prices fall in real time. And so you are probably no longer in a hurry to make that large purchase because you're going to say, why would I go and buy the thing if it's going to be cheaper every time I go back to the store? This is why inflation begets inflation in Canada, because if people are fearful of inflation, they go and spend in response to it, creating inflation. But deflation begets deflation, because if people see prices falling, then they're less likely to buy the thing, which means that fewer buyers means prices will fall more. And the housing market is a place where you really see this. Buyers aren't in a hurry to jump into the market because they see prices are falling. And if we think about all of these people who are up against the renewal wall, they might say, I'm actually not really afraid to sell my house right now because I can probably buy it back or buy the similar product back cheaper in a year or two based on what the current price trend is telling. And you really have to think about that deflation psychology when you examine what not just buyers are doing in the market, but also what sellers are doing in the market. Nobody does want to sell their house, right? It's probably has sentimental value. They've lived there. They've made a home out of it. They're comfortable with it. It's probably not high on their list of things that they want to do. But when you're backed up against a wall, you might be increasingly more likely to do it if you're not afraid that in doing so, you're going to risk getting priced out of the market. And there's no longer a FOMO or fear of missing out or fear of getting priced out of the market. People are seeing that prices aren't running away. And so they're less reluctant to sell. Now, this surge of renewals is obviously heavily influencing mortgage data. It's a big reason why we're seeing origination spiking. It's not this sudden housing boom that is causing headlines or charts like this one. It is the renewal wall, or the Equifax Canada report recently dubbed it the Great Renewal. A wave of pandemic era mortgages now coming up for renewal. And with so many loans rolling over, renewal and refinancing activity has exploded, especially in places like Alberta and BC and Ontario, where lots of people are rate shopping between lenders to go and try and get the best deal on renewal. One data point in that regard, about 28% of renewing borrowers have been switching lenders to try and find better rates, and nearly half of those switchers moved between the big five banks. So there's fierce competition in the mortgage market right now to retain customers. Now, I promised at the beginning of this video, I would explain the base effect and why a 27% spike isn't as crazy as it sounds. We know there's lots of renewals happening. It's a pretty big jump year over year for June renewals. And this is where it's really important to understand the base effect. It's a thing in statistics that explains why such a huge percentage spike might be partly an illusion in the math. The base effect basically says that when you're comparing two periods, the percentage change can look exaggerated if you start from an unusually low point. And you can see that in June of 2024, we saw a pretty low number, at least by comparison to the Junes of the three prior years, 21, 22, and 23 here. It was a pretty big drop. And you'll see this base effect a lot in the real estate market when people are saying, oh, home sales are up massively in August of this year. People are saying, oh, home sales are up like 10% from August of last year. August of last year was a really slow month. So are we really getting excited about this? We're still way below the long-term average. And so in this case, the number of mortgage originations a year ago was particularly low because a year ago, Canada's housing market was very slow and we weren't in that renewal mall. Home sales and mortgage activity had cooled off significantly due to higher interest rates and buyer hesitation. So the number of new mortgages back then was depressed. And now in early 2025, we have this flood of renewals and modest rebound in home buying. Even if the actual number of mortgages didn't hit all-time records, it's still way higher than that low point last year. And so the year-over-year percentage jump looks huge. This is a really classic example of a low base effect. Again, super common in the real estate industry, where you have a lot of industry groups trying to use numbers to excite the market. And so in short, part of this sharp rise is just statistical. It doesn't mean that 27% more people are buying houses out of nowhere. It means that last year was unusually quiet and this year was more normal plus the renewal wave. So we should take the percentage with a giant grain of salt. Let's finish off here with why this matters to the average person. You might be thinking, okay, so a bunch of charts, data spiked, why should I care? The surge in renewals has an impact on Canadians and the broader economy. The big one is we're seeing the higher payments and affordability getting worse, right? Because many people are now renewing and facing much higher interest rates than they originally had. This means higher mortgage payments for the same mortgage. Imagine just having to pay hundreds more for your mortgage per month when you renew. This is going to be the reality for a lot of households in Canada. And this can really squeeze family budgets. Affordability is still a big issue. We're still hearing about a housing crisis in Canada. It hasn't just magically gone away. And so with budgets tighter, some homeowners might struggle to make all their payments. And we're already seeing more Canadians missing payments on various loans, including mortgages, cars, credit cards. 1 in 22 consumers missed at least one debt payment in early 2025, according to Canadian Mortgage Trend. And there's also evidence that about 20% of renewing homeowners had to use other credit, like credit cards or lines of credit, to cover their mortgage debts, according to a recent CMHC report, which is just not sustainable long term. This kind of financial stress can delay people's other life plans, saving for retirement, etc., and generally makes consumers more cautious. And there's an economic ripple effect to be seen here as well. We have a huge chunk of people now diverting more income to mortgage payments. Consumer spending can slow down, and we're already seeing consumer spending slowing down. This means less money for restaurants, travel, new appliances, renovations, whatever, the things that keep the economy going, buying a new car, whatever. And the Bank of Canada has explicitly flagged this, that higher mortgage payments could cause Canadian households to cut back on spending, potentially slowing the economy. If enough people pull back, businesses will feel it, and it can cool economic growth, which is already cooling independent of the consumer, based on my last video about the recession that we're seeing in Canada. And so policymakers are going to be watching the situation closely. The Bank of Canada, when setting interest rates, is aware of this renewal wall impact. They don't necessarily care a ton about it because their primary mandate is inflation, but they're certainly paying attention to it. And finally, this matters for the housing market itself. If too many people struggle with higher payments, some might be forced to sell their homes, which could add supply and put downward pressure on prices. Or conversely, if banks and borrowers find a way to manage, the market could stay relatively stable. And the concern is that a debt-laden population is not a resilient one. So what's the takeaway here? To recap, Canada's spike in mortgage originations isn't quite what it seems at first glance. Yes, the numbers shot up higher than last year, almost 58% on an annualized basis, but that's largely because of this renewal wave and the statistical base effect. And mortgage originations include renewals and refinances, so the renewal wall gets captured in that. This matters because it affects people's real wallets, their real money, and the health of the economy. Higher mortgage payments for millions of households can squeeze budgets, potentially slow spending, and put some folks in financial stress, all of which policymakers and banks are carefully monitoring. So let me know your thoughts in the comments. Are you going to be facing a mortgage renewal in the next couple of years? If so, how much is your payment going to go? And if not, what do you think the consequences of this in Canada's real estate market are going to be? Thanks a lot for taking the time to watch this video. As always, if you found this video even remotely helpful, please give it a thumbs up. Consider subscribing for more insights. I'd just like to thank you for taking the time to watch this video. It means a lot to me that you gave me the time out of your day, and I'll see you as soon as I can.